Question 1. An insured fails to pay their life insurance premium within the required timeframe. The policy remains in force for a specific period after the premium due date, preventing immediate lapse. This period is known as the A. Free look period, B. Reinstatement period, C. Grace period, D. Contestable period. Answer: C. Grace period. The grace period is a stipulated time, typically 30 or 31 days after the premium due date, during which a life insurance policy remains in force even if the premium has not been paid. This provision is designed to prevent unintentional policy lapses, allowing the policy owner a short window to make the payment without losing coverage. If the insured dies during this period, the death benefit is still paid, minus any overdue premium. Always remember that the grace period offers a crucial safety net for policyholders to maintain their coverage. Question 2. Which type of life insurance policy is characterized by a level premium, guaranteed cash value accumulation, and a death benefit that remains level for the entire life of the insured? A. Decreasing term life, B. Universal life, C. Whole life, D. Variable life. Answer: C. Whole life. Whole life insurance is a permanent life insurance policy that offers a guaranteed level premium, a guaranteed death benefit, and cash value accumulation that grows on a guaranteed schedule. The cash value component is a key feature, as it can be accessed by the policy owner through loans or withdrawals. This type of policy provides lifelong coverage, meaning it remains in force as long as premiums are paid or until maturity. Think of whole life as a stable, predictable option for lifelong financial protection. Question 3. What is the primary purpose of an annuity? A. To provide a death benefit to beneficiaries upon the insured's death. B. To offer a lump sum payment upon the diagnosis of a critical illness. C. To accumulate funds and then provide a stream of income during retirement. D. To protect against disability by replacing lost income. Answer: C. To accumulate funds and then provide a stream of income during retirement. The primary purpose of an annuity is to provide a systematic liquidation of a sum of money, typically during retirement, by distributing it as a stream of income. Annuities involve two main phases: an accumulation phase where funds grow, and an annuitization phase where payments begin. Unlike life insurance, which protects against the risk of dying too soon, annuities protect against the risk of living too long and outliving one's savings. Consider an annuity as a financial tool for ensuring consistent income throughout your retirement years. Question 4. A policy owner adds a rider to their life insurance policy that will pay the premium if they become totally disabled. This rider is known as the A. Accidental death benefit rider, B. Guaranteed insurability rider, C. Waiver of premium rider, D. Payer benefit rider. Answer: C. Waiver of premium rider. The waiver of premium rider is a valuable addition to a life insurance policy, as it ensures that if the insured becomes totally and permanently disabled before a certain age, the insurer will waive all future premiums for the duration of the disability. This means the policy remains in force without the policy owner having to pay out of pocket, protecting their coverage during a time of financial hardship. This rider is designed to prevent policy lapse due to an inability to pay premiums resulting from disability. Always remember that this rider safeguards your coverage when you need it most. Question 5. An employer purchases a life insurance policy on a valuable employee to cover potential financial losses if that employee dies. This is an example of what type of business insurance? A. Buy-sell agreement, B. Key person insurance, C. Deferred compensation plan, D. Business overhead expense. Answer: B. Key person insurance. Key person insurance is a type of business life insurance purchased by an employer on the life of an employee whose skills, knowledge, or leadership are critical to the company's success. If the key person dies, the policy pays a death benefit to the business, helping to offset financial losses incurred during the search for a replacement or while adjusting to their absence. This coverage provides a crucial financial safety net for a business dependent on specific individuals. Think of it as protecting the valuable human capital within a company. Question 6. A life insurance policy states that after 2 years from its issue date, the insurer cannot void the policy due to misstatements made in the application, except for fraudulent misstatements. This policy provision is called the A. Grace period, B. Reinstatement clause, C. Incontestability clause, D. Free look period. Answer: C. Incontestability clause. The incontestability clause states that, typically after 2 years from the policy's issue date, the insurer cannot challenge the validity of the policy or deny a claim based on misrepresentations or concealments in the application, even if they are material. The only exception is for outright fraudulent misstatements, which can void the policy at any time. This clause protects policy owners from having their coverage challenged years after the policy was issued. It provides peace of mind that once the contestable period passes, the policy's validity is secure. Question 7. Which characteristic best describes a level-term life insurance policy? A. It has a fluctuating premium and builds cash value. B. It has a level death benefit and no cash value. C. It has a decreasing death benefit and accumulates cash value. D. It provides coverage for the insured's entire life. Answer: B. It has a level death benefit and no cash value. Level term life insurance provides a death benefit that remains constant, or level, throughout the entire policy term. Unlike permanent insurance, term policies do not build cash value and are designed to provide coverage for a specific period of time, such as 10, 20, or 30 years. If the insured dies within the specified term, the death benefit is paid to the beneficiaries. This type of policy is typically less expensive than permanent insurance, making it suitable for temporary protection needs. Question 8. How are death benefits from a life insurance policy generally treated for income tax purposes in the U.S.? A. They are fully taxable as ordinary income. B. They are partially taxable, depending on the recipient's income. C. They are generally received income tax-free by the beneficiary. D. They are subject to capital gains tax. Answer: C. They are generally received income tax-free by the beneficiary. In the United States, death benefits paid to beneficiaries from a life insurance policy are generally received income tax-free. This significant tax advantage makes life insurance a powerful tool for estate planning and providing financial security to loved ones. While the death benefit is income tax-free, it may be subject to estate taxes if the policy is included in the deceased's taxable estate, but this is a different type of tax. Remember this key benefit: life insurance proceeds offer tax-advantaged financial relief to beneficiaries. Question 9. If an insured misstates their age on a life insurance application and it's discovered after the policy is issued, what action will the insurer most likely take? A. The policy will be voided, and premiums returned. B. The policy's cash value will be forfeited. C. The death benefit will be adjusted to what the premium would have purchased at the correct age. D. The policy's premium will be increased to reflect the correct age. Answer: C. The death benefit will be adjusted to what the premium would have purchased at the correct age. The misstatement of age or sex provision in a life insurance policy dictates that if the insured's age or sex was misstated on the application, the death benefit will be adjusted to the amount that the premium paid would have purchased at the correct age or sex. The policy itself is not voided, and the premium is not changed, but rather the payout amount is corrected. This ensures fairness, as actuarial calculations rely heavily on accurate age and sex for premium determination. This provision allows the policy to remain in force while correcting for the factual inaccuracy. Question 10. A life insurance policy names my children, per stirpes, as beneficiaries. If one child dies before the insured, who would receive that deceased child's share of the death benefit? A. The remaining children equally. B. The deceased child's heirs. C. The insured's estate. D. The policy would be forfeited. Answer: B. The deceased child's heirs. The per stirpes, Latin for by roots or by branches, beneficiary designation means that if a named beneficiary dies before the insured, that deceased beneficiary's share of the death benefit will pass to their direct descendants, their children or grandchildren. This contrasts with per capita, per head, where the death benefit is divided equally among the surviving named beneficiaries. This designation ensures that the inheritance stays within the deceased beneficiary's family line, even if they predecease the insured. Question 11. A life insurance policy includes a provision stating that if the insured commits suicide within 2 years of the policy's issue date, the insurer's liability is limited to a refund of premiums paid. What is this provision called? A. Incontestability clause. B. Suicide clause. C. Free look period. D. Grace period. Answer: B. Suicide clause. The suicide clause is a standard provision in life insurance policies that limits the insurer's liability if the insured commits suicide within a specified period, usually 2 years, from the policy's issue date. If suicide occurs within this period, the insurer typically only refunds the premiums paid, rather than paying the full death benefit. After this 2-year period, the full death benefit would be paid. This clause is designed to prevent individuals from purchasing life insurance with the intent of committing suicide. Question 12. An insured decides to surrender their whole life policy but wants to use the cash value to purchase a new single premium policy with a reduced face amount. Which non-forfeiture option are they choosing? A. Cash surrender value. B. Extended term. C. Reduced paid up. D. Automatic premium loan. Answer: C. Reduced paid up. The reduced paid up non-forfeiture option allows a policy owner to use the existing cash value of a surrendered life insurance policy to purchase a new, fully paid up permanent policy with a reduced face amount. No further premiums are required for this new policy, and it will remain in force for the remainder of the insured's life. This option maintains lifetime coverage, albeit for a smaller death benefit, without any ongoing premium payments. It's a way to keep some coverage in force without continued financial obligation. Question 13. What is the source of funds for a policy loan taken against a whole life insurance policy? A. The insurer's general account assets. B. The policy's accumulated cash value. C. Future premiums to be paid by the insured. D. A third-party bank or lender. Answer: B. The policy's accumulated cash value. A policy loan is an advance against the accumulated cash value of a whole life insurance policy. The policy owner is borrowing their own money, so to speak, from the policy's cash value, and the loan does not have to be repaid, although interest accrues. If the loan is not repaid, the outstanding loan amount and any accrued interest will be deducted from the death benefit when the insured dies. This feature provides policyholders with a readily accessible source of funds. Question 14. An agent convinces a policy owner to cancel an existing life insurance policy and purchase a new one, primarily to earn a higher commission, without a clear benefit to the policy owner. This unethical practice is known as A. Churning. B. Rebating. C. Twisting. D. Coercion. Answer: C. Twisting. Twisting is an illegal and unethical practice where an agent persuades a policy owner to replace an existing life insurance policy with a new one, typically from a different insurer, by misrepresenting or making incomplete comparisons of the two policies. The primary motive is often to generate a new commission for the agent, rather than serving the policy owner's best interest. It is crucial for agents to always prioritize the client's needs and provide accurate, unbiased information when discussing policy replacements. Question 15. An applicant submits an application for a life insurance policy along with the initial premium. The agent provides a receipt stating that coverage is effective immediately, provided the applicant is found to be insurable. What type of receipt is this? A. Binding receipt. B. Conditional receipt. C. Absolute receipt. D. Temporary receipt. Answer: B. Conditional receipt. A conditional receipt provides coverage as of the date of the application or the date of the medical exam, whichever is later, assuming the applicant is found to be insurable according to the insurer's underwriting standards. If the applicant dies before the policy is issued but while the conditional receipt is in force, the death benefit will be paid if the applicant would have been approved. This means the coverage is conditional upon the insurability of the applicant. This type of receipt offers applicants immediate, albeit conditional, protection. Question 16. Which of the following is a common characteristic of group life insurance? A. Individual underwriting is required for each participant. B. The policy is owned by each individual certificate holder. C. Coverage is provided under one master contract. D. Premiums are based on the individual's health and age. Answer: C. Coverage is provided under one master contract. Group life insurance provides coverage to a group of individuals, typically employees of a common employer, under a single master policy. Instead of individual underwriting, the insurer assesses the risk of the entire group. Each insured individual receives a certificate of insurance as evidence of coverage, but the employer or organization owns the master policy. This structure allows for lower administrative costs and often provides coverage to individuals who might not qualify for individual policies. Question 17. Which life insurance policy type offers flexible premiums and a flexible death benefit, allowing the policy owner to adjust them as needs change? A. Whole life. B. Term life. C. Universal life. D. Variable life. Answer: C. Universal life. Universal life insurance is a flexible premium, adjustable life insurance policy that allows the policy owner to vary the amount of premium paid and the death benefit. Unlike whole life, which has fixed premiums, universal life allows policy owners to pay more or less than the planned premium, affecting the cash value accumulation. This flexibility makes it adaptable to changing financial circumstances and protection needs over time. It essentially combines the benefits of a savings vehicle with adjustable life insurance coverage. Question 18. A rider is added to a life insurance policy that pays an additional death benefit if the insured's death is caused by an accident. What is this rider called? A. Waiver of premium. B. Guaranteed insurability. C. Accidental death benefit. D. Cost of living. Answer: C. Accidental death benefit. The accidental death benefit (ADB) rider, often called double indemnity, pays an additional death benefit to the beneficiaries if the insured's death is the result of an accident, as defined in the policy. For example, if the face amount is $100,000 and the ADB rider is for $100,000, an accidental death would pay $200,000. This rider provides enhanced financial protection specifically for unexpected and tragic accidental fatalities. Always review the policy's definition of accident to understand the circumstances under which this rider applies. Question 19. During the underwriting process for a life insurance policy, an applicant is classified as a substandard risk. What does this classification typically indicate about the applicant? A. They are expected to live longer than average and will pay lower premiums. B. They meet the insurer's normal underwriting standards and will pay standard premiums. C. They pose a higher than average risk to the insurer and will pay higher premiums. D. They are uninsurable and will be declined coverage. Answer: C. They pose a higher than average risk to the insurer and will pay higher premiums. A substandard risk classification means the applicant presents a higher than average risk of loss to the insurer due to health issues, hazardous occupations, or dangerous hobbies. To compensate for this increased risk, the insurer will typically issue the policy at a higher premium rate, often called a rated policy. This classification allows individuals with specific risk factors to still obtain coverage, albeit at a higher cost. It's important to understand that such ratings are common and help insurers manage their overall risk pool. Question 20. What is the primary purpose of the free look period in a life insurance policy? A. To allow the insurer to contest the policy for misrepresentations. B. To permit the policy owner to review the policy and return it for a full refund. C. To enable the insured to change beneficiaries without penalty. D. To provide a grace period for premium payments. Answer: B. To permit the policy owner to review the policy and return it for a full refund. The free look period, typically 10 days, or longer, like 20 to 30 days for replacement policies or those over 60, from the date the policy is delivered, allows the policy owner to review the policy terms and conditions. If they are not satisfied for any reason, they can return the policy to the insurer for a full refund of all premiums paid. This consumer protection feature ensures that policy owners have time to fully understand their purchase and are not pressured into keeping a policy they do not want. It's a vital safeguard for new policyholders. Question 21. A policy owner temporarily assigns a portion of their life insurance policy's death benefit to a bank as collateral for a loan. What type of assignment is this? A. Absolute assignment. B. Collateral assignment. C. Vested assignment. D. Partial assignment. Answer: B. Collateral assignment. A collateral assignment is a temporary transfer of some or all of the policy's ownership rights to another party, typically a creditor, as security for a debt. When the loan is repaid, the assignment is terminated, and full rights revert to the original policy owner. If the insured dies before the loan is repaid, the lender can collect the outstanding loan amount from the death benefit, with any remaining proceeds going to the policy's beneficiaries. This type of assignment is a common way to use life insurance as loan security. Question 22. Which characteristic distinguishes a variable annuity from a fixed annuity? A. Guaranteed minimum interest rate. B. Investment performance is linked to a separate account. C. Payments are guaranteed and fixed once annuitized. D. It is not regulated by the SEC. Answer: B. Investment performance is linked to a separate account. A variable annuity invests the annuitant's premiums into a separate account, which consists of various investment options like mutual funds. The growth of the cash value and the eventual income payments are not guaranteed but fluctuate based on the performance of these underlying investments. This contrasts with a fixed annuity, which offers guaranteed interest rates and fixed payments. Because variable annuities involve investment risk, they are considered securities and are regulated by the Securities and Exchange Commission, SEC, requiring producers to hold a securities license in addition to a life insurance license. Question 23. An insured's life insurance policy lapsed due to non-payment of premiums. The policy owner wants to restore the coverage. What policy provision allows them to do this? A. Grace period. B. Reinstatement clause. C. Free look period. D. Non-forfeiture options. Answer: B. Reinstatement clause. The reinstatement clause allows a policy owner to reactivate a lapsed life insurance policy, typically within a certain time frame, e.g., 3 to 5 years, after it lapsed. To reinstate, the policy owner usually must pay all back premiums with interest, prove insurability, often through a medical exam, and repay any outstanding policy loans. Reinstatement is generally preferable to purchasing a new policy because the original policy's issue age and therefore the premium rate can be retained. This provision provides an opportunity to regain coverage without starting anew. Question 24. A beneficiary chooses to receive life insurance death benefits in equal installments over a specific period of time, rather than a lump sum. This is an example of which settlement option? A. Interest only. B. Fixed amount. C. Fixed period. D. Life income. Answer: C. Fixed period. The fixed period settlement option allows the beneficiary to receive the death benefit in equal installments over a specified period of time. The amount of each installment is determined by the total death benefit, the chosen duration, and a guaranteed interest rate. If the beneficiary dies before the end of the period, the remaining payments typically go to their heirs. This option provides a predictable income stream for a defined timeframe, which can be useful for specific financial planning needs, like covering a child's college expenses. Question 25. Statements made by an applicant on a life insurance application are generally considered to be A. Warranties. B. Guarantees. C. Representations. D. Conditions. Answer: C. Representations. Statements made by an applicant on a life insurance application are considered representations, which are statements believed to be true to the best of the applicant's knowledge and belief. They are not guaranteed to be absolutely true, but they are material to the insurer's decision to issue a policy. If a material misrepresentation is discovered within the contestable period, the insurer may have grounds to void the policy. This standard ensures applicants provide accurate information without requiring absolute infallibility.